I like to hear from people who've been around, who have done it, who have failed, who have succeeded. I don't want to hear the obnoxious pricks who talks about his success all the time, but from real people with hands-on experience. That's what this panel is all about. At the end of the day, it comes from the heart. You have to be very passionate about what you do. Number two, you have to have the background, the analytics, the know-how. Passion by itself doesn't lead anywhere. It starts with passion, but you have to have the ammos, the ammunitions to execute on your passion. Welcome, folks. Good to see you here. Welcome to our fourth event of the year. I don't like to do speeches, and I'm not going to do a speech. But I think I want to share with you something today I just thought about this morning when I woke up. What is the Financial Policy Council? What do we stand for? For all of the newcomers, I'm sure they want to know this. For the older guests, people who've been coming here for the last 9 years, I think you know already. Look, we started this organization in July 2010. So we're going into our 10th year. This is our 9th year already. We are July 2019. 55 events later, 300,000 followers later, 45 sponsors later, what have we accomplished other than that, and what are we doing here? We're not here to do events or to bore you with some academic crap like most of the nonprofits do. Sit down, people start yawning, some people showing them, PowerPoint presentations, and then they walk back home. That's it. Next day, they have forgotten about this event, their events. You're not going to forget about this event with what I'm going to say and what these guys are going to say. Capitalism today is under siege. It's obvious. Yes, it is political. We're not a political organization, but business is becoming political. Socialists, communists, all these crazy ideas of wealth destruction are coming to bear. What do? We are here a boot camp for capitalism. We brag about it, we're not afraid to say it, and we're here to create and help our members, our supporters, our sponsors create obscene wealth. It's as blunt as this. I'm not going to mince my words. We're here for the money. If you don't like it, you can walk out right now. Very simple. We're here to create millionaires and billionaires and have wealth creators, a group, an exclusive group of deal makers, wealth creators in every single asset class. Real estate, cryptocurrency, you name it. Every single asset class you can think about. So the goal is to bring in experts in those asset classes with skin in the game to explain to you what they have done, share with you their experiences. Not to bring professors, academics to pontificate. I don't want to hear somebody who makes $200,000 a year to come and tell me how to make money. That's not money. That's not even chicken shit. Okay? We want to hear from people who have done it, who have failed in doing it. And we want to honor and feature the next generation of entrepreneurs. We may be the only nonprofit organization who honors, awards, and features entrepreneurs at every event because they are the backbone of this country. They're fearless, they're focused, they're disruptors, and they want to make change. This is our constituents. Entrepreneurs, disruptors, mavericks, rebels, wealth creators. If you're offended, get the hell out of this room. I don't want to deal with people who are offended or who feel bad or who think it's not fair and balanced. I don't want it to be fair and balanced. It's our way, the only way, wealth creation. There's no fair and feeling and all that kind of stuff. It doesn't work. You cannot imagine how much this country and capitalism is under siege. This is not, I used to talk about this like 5 years ago. It was not really then there, but now it's there. There is extreme anger, jealousy, to bring us down. We're bootstrapping this. We are the first line of defense. We want to create more organizations like this. We want this organization to go into hundreds of thousands of people, all wealth creators or deal makers or independent from any government, any handout, any corporation, anything. Each one of you should be a self-sustaining cash machine. Troy Inc., Ziad Inc., Harry Inc., Marco Inc., that can produce wealth. This is how we're going to take back our country. This is how we're going to take back our freedom. Because remember, mark my words, make no mistake about it, money is about freedom. That's the most important thing. It's not about acquiring things, flaunting things, showing off your new car, your new plane, your new apartment, your new house. No. It's basically having enough money not to take crap from anyone, anywhere, anytime. That's freedom. That's the power. The power to tell your boss, or whoever, take a hike. I don't need you. A lot of people with money, they still are not free. They are under the shackles of this political group, of this agenda, etc. You really want to be happy and content, you've got to be free. And a lot of people forgot about that. They've become slaves to money, not money slaves to them. Making money while you sleep, while you're free. This is what we're trying to empower people here, educate people. This is what the Financial Policy Council is all about. And there is no such organization, I'm telling you, and we've done research in this country, that's as bold as us in the agenda. And I really, honestly, would tremendously appreciate your support in taking this organization in the next decade. We're going into our 10th year, to the second level. If this organization sinks, we all sink. If we succeed, we're all here are becoming much more powerful. A lot of people already do business between the members, the supporters. We don't ask for fees on commissions, etc. Do business. Be rich. Yes, exchange more cards. Be bold about it. Be creative. There's a lot of money in this room. People seeking money, but also there's a lot of money in this room. So go for it. That's all what I want to say here. I don't want to bore you with more details. I just would like to thank, number one, the board members who have supported this organization throughout the years. Please stand up for a standing ovation. I'd like to thank our 45 sponsors, too long to name in here, but specific thanks right now to the current supporter of this event, Minerva Capital Management, Stanford Silverman.
Thank you.
Okay, let's start with the Entrepreneur of the Month. It goes to Vladimir Lunigov, co-founder and CEO of mBank, a Silicon Valley-based fintech. In 3 short years, mBank developed and brought to market the next generation digital banking core and became one of the fastest growing and most comprehensive banking service providers in the world. Vladimir, I invite you to the podium to receive our award.
Well, thank you very much for admitting me to Entrepreneurs Circle. I'm sincerely grateful to be here. This organization is driven by talented and hardworking individuals. And like everybody else, myself too, I share same goals, I share same dreams, I share same aspirations. Wealth creation has always been one of the driving factors for me. My definition of wealth creation is not just wealth created for myself, but also for the people who I work with. I would like to have everybody who ever touches one way or another our organization, mBank, or anything that we do, to be on the path of wealth creation also. All right, so the title of my speech today is What Doesn't Kill You Makes You Stronger. I hope this is controversial enough. Today I'm the CEO of mBank. Huh? Keep pushing. Keep pushing, okay, got it. Right. Yeah. Today I'm the CEO of mBank, one of the fastest growing fintechs, and thank you very much for the introduction. I would like to talk a little bit about my professional career, where I came from and how it all started, and where I am today, and what's defined me as an entrepreneur. My professional career started in the year 2000, when I graduated from the London School of Economics and Political Science, University of London. I graduated with a degree in international relations, and with it, I basically inherited this belief in humanitarian nature of all of us as human beings. And that's something that's driven me through my entire career, taking care of the people who are around me, people who work with me, people who trust me, and people who are under my umbrella or umbrella of our organization. So my first job took me from the position of an apprentice to general manager in a London-based private equity fund. So my 6 years of experience at private equity fund were marked by a number of spectacular failures. My 11-year-old son would say epic fails, if you like, and some successes, of course. So some of the failures included the following. In 2001, we invested heavily in the creation of a video phone, a desktop appliance delivering video conferencing solution through ISDN lines. So some guys here will know what ISDN lines are. Mm-hmm. So it kind of seems irrelevant in this day and age. In 2002, we invested in the creation of a fast internet delivery service over phone lines. You remember the dial-up, right? So we basically created something that would bring faster internet through the same dial-up service. That business was completely obliterated and killed the following year by ADSL. So that was a fail. But one of the largest, financially one of the largest fails was a low-cost airline. So we basically invested in the first in the United Kingdom low-cost airline operating out of Kent International Airport, which is just outside of London, called EUJet. And the airline never actually took off. So we failed even before we started. We were well ahead of our time. Right, well, having said that, these and many more failures formed me as an individual, they formed me as an entrepreneur, and they're the reason why I'm here today. So at the end of my 6 years in private equity, I ran a successful management buyout of one of our businesses, an international publishing house. I took 6 months to restructure the business, package it, and then sell it to a Japanese conglomerate. I didn't make a lot of money, it was a mini exit. However, it was enough for me to buy a house and start a family. So this chapter in my life, the private equity chapter, basically taught me that there are a lot of ideas floating around. It's very hard to determine which ones will succeed and which ones are good ones, which ones are not so good, right? But nonetheless, we as entrepreneurs, we as individuals, we need to trust our intuition. We need to follow our hearts. And if it doesn't work, that's fine. It will make us stronger. We will learn. Next time we'll do better. So the second chapter of my professional experience really is represented by 10 years in consulting, Big Four consulting. So I worked in 3 out of 4 Big Four accounting firms. So
exciting work.
Exciting work. Well, a lot of miles. That's true. Well, through my consulting experience, I was able to see the inner workings of the banks. It's kind of a very interesting and strange vantage point, something that you do not see as a banking consumer, or you do not see it even when you work in a bank. But if you're consulting and basically have to advise on technology, then you actually have access, you have first-hand experience of how antiquated all of those systems are and how dilapidated, I guess, in a way the infrastructure is. So after several years of consulting major financial institutions on strategy and operations, I basically realized that the entire industry was crippled by an oligopoly of just a handful of technology vendors. There are only 4, actually. So we as consultants, we were advising banks to switch from one technology or one system that was created in the 90s to another system that was created in the 90s. And we're talking about the most lucrative and largest market in the world. So, so my aha moment really happened when I realized that those incumbent technology players serving 96% of the US of the banks in the United States, they are actually strangling banks and creating barriers to switching and barriers to innovation. And I thought to myself, there must be another way. So the learning of that chapter was that there will be barriers. Barriers will be people. Barriers will be competition. There will be barriers by the companies that's already been established. But be bold, persevere, do not be afraid, and you will succeed. If you don't succeed the first time around, just stick with it and do for as long as you can, and then you will win. So after about 4 years ago, I realized that there must be another way, and that other way was something that really led me to founding mBank. Arguably, leaving consulting was probably amongst the best decisions I've ever made in my life. Yeah, I sincerely respect KPMG, Ernst & Young, and PwC, but leaving them was actually life-changing for me, and I'm so glad that I made that decision. So the good thing is that I was joined by like-minded individuals, like Joe Reynoso, our chairman, who is in the audience today. He's a hedge fund veteran from Chicago. Lars Rottweiler, our CTO, a former Deutsche Bank executive. Richard Bilecki and the Fedor Bank team. Carlo Cosina, our European operations team. And most recently, Alex Lopatin, who some of you know, founder of Nimbus, who joined us to lead our efforts in the US market. So the third and current chapter in my professional career really is mBank, is what I'm doing right now. Thank you, Ziad, for the introduction. So you already told us what the banks are about, but let me tell you something about a bank. What is a bank? So despite a popular belief, banks are not run by people. Banks are run by software. So much so that 30% or more, 36% of banks' expenses are actually IT related. And out of all those expenses, about half of it relates to something which is called core banking. So, so the core banking, the foundational technology of a bank is core banking. My personal belief, and I do strongly believe in this, is that foundational technology in any bank should be free. Anybody should be able to start a bank. It can be Ziad Bank, it can be Javier Bank, it can be a Joe Bank. And this is what I've had in mind when I created mBank. Something that is so easy, and banking is easy. It's made complicated. It appears complicated, right? It's overly cumbersome. But the reason for that is because it's old and antiquated, and it represents a patchwork of thousands of systems. However, if you cut through this complexity, then you can create something which is elegant and doesn't cost you so much money, doesn't cost you so much effort. So I do believe that the foundational technology that runs a bank should be free. Technology and compliance should not be a burden, but an enabler. I believe the only way, this is the only way to foster innovation in financial services, to improve transparency and stability of the financial system. I guess the biggest achievement really, or the biggest thing that I've opened up to myself is that this freedom, this choice of who I work with, the choice of who my clients are, the choice of who my investors are, and the team, we've handpicked, you know, the entire team is handpicked. All of our investors are handpicked. We operate as one unit. We think alike. All of our clients are handpicked. This kind of freedom only comes to you as an entrepreneur. It does not come to you if you're working in a large setting, in a big four organization. So sometimes, you know, I think to myself, oh my God, if I knew this, if I had the crystal ball, why would I stay in consulting for 10 years? But it's self-inflicted, you know, it's pain, and it grew, it probably had to grow. Well, so right now we are at the stage when the old status quo is not sustainable anymore. And I think that this year and next year, especially the next maybe 18 to 24 months, we'll see a lot of changes. Now, those changes are so significant, and let's not underestimate them, that the traditional institutions who are already finding it hard to keep their clientele to be abreast of the latest technology, they are already struggling in a way. And just in the last 1 or 2 weeks, the announcements of challenger banks from Europe entering the US market, you know, do you think that the position that Bank of America has right now, the position that Chase has right now, do you think it's sustainable? I don't have a crystal ball, but I can tell you that in 5 years, I do not see Bank of America growing their customer base. So I also do not believe that we need to disrupt something that already works. We create something new, and we create choices for the consumers. Right now, there are no choices. Why? Because Bank of America and Chase and all the other banks, they basically run on one of the four exactly. However, what if you want something different? What if you're a different kind of an individual, right? What if you have property abroad? What if you have travel plans? What if your kid goes to a university in a different country or in a different place? What if you are participating in this large gig economy, Upwork or something else, and you're based out of you know, Bangladesh or Southeast Asia, right? But you're still serving the U.S. consumers. So all of those segments, they're so underbanked that to bring them, to give them access to financial services that they deserve is such a low-hanging fruit. You ask me, what's a low-hanging fruit? And it's actually not so difficult to understand their demands. It's difficult to deliver the services to them using antiquated systems. Okay, this is not theoretical. This is practical. When it comes down to people, it's the biggest obstacle I see now and in the future is finding the right resources, finding the right people, and finding the right energy. I think the biggest issue, the biggest impediment for success of any entrepreneur is the energy around. There is money, you know, so if you really want to fundraise and get dumb money, it's possible, right? But can you get the same energy? Can you get the people who breathe the same way that you do, people who understand what you're trying to solve for, and actually people who are able to support you in the end? Why? Because your goals are noble, your goals are big. You're not here to burn bridges, you're here to create options, you're here to create wealth. And with that, you're here to create freedom. Thank you.
So guys, you've got to push the envelope all the time. You're going to test your limits over time. You can never be satisfied. And when people ask you, oh, have you made enough money? You have enough money, so what are you still doing? My answer is always more. That's it. Don't ever be satisfied. Don't ever get pulled down. Know what you're doing. Anyway, let's go to the panel, to the great panel we have here. So we have a great panel here. We're going to keep it very focused. We have Troy Gayeski, Partner, Co-Chief Investment Officer, and Senior Portfolio Management with Skybridge.
Yay!
Hey, Troy!
Thank you, thank you.
We have Stanford Silverman, President Silverberry, and founder and CEO, Minerva Capital Management, and sponsor of this event.
Bravo!
Michael Lauer, President, Hedge Fund Concepts. And Deepak Narula, Managing Partner, Meta Capital Management.
Hey, Deepak.
Deepak.
So I'm not going to go through the bios of each one of them. That's boring.
Yeah, that's for sure.
Why don't you, each one of you, share, in no more than a couple of minutes, your personal and professional background in your own words. A couple of minutes.
Want to go first?
Yep. You can go this way.
I went to technology school up in Boston. Loved engineering and science, solving problems, but I like to interact with people, and I found that science and engineering, you didn't get a chance to do that a lot. Worked briefly in industry, transitioned to the hedge fund industry. Was very fortunate to work for Ray Nolte at Citigroup, where we ran their fund of hedge funds group there, and then was lucky once again when Anthony Scaramucci purchased our firm out of a Citi. So we've all been partners now, approaching 9 years. We'll be 10 soon enough. And we've done fairly well by focusing on where there's inefficiencies in hedge funds, where there's capital market opportunities, which we're going to talk about today. And as an entrepreneur, in anything you do, you have to be willing to take risk, right? And that's a key component. And so we'll talk about some of those risks today.
Thank you, Troy.
Good.
Stan?
Was that brief enough?
Perfect.
Nice.
I spent 30 plus years in the advertising business, owning an advertising agency, working in the education vertical, helping school owners to get rich by putting students in seats. After many years in the business and being very frustrated because while they were doing the job, they weren't doing it well. And they didn't want to listen because they were entrepreneurs and thought they knew it all. I was frustrated. I spoke to a few friends, one of which is sitting next to me, my friend Michael, and I said, why the hell are you doing this for someone else? Why don't you do it for yourself? And I said, well, what are you saying to me? He said, start a hedge fund. And Michael, probably one of the most successful hedge fund guys who've come into the business, said, I'll show you how to do it. So that was 2 years ago. I started a hedge fund with a dear friend of mine who had been in the business also, in the managerial part of the business for 30 plus years also, former Navy SEAL. And we started our business, and 2 years later, we're just about to complete a $170 million roll-up of about 100 schools, looking at EBITDA somewhere around $30 million with a 5-year projection on our pro forma of about 2.4 billion when we take it to market. So I love the business. I love changing people's lives. I love being a disruptor, and I love going in and seeing people who stalled for 5 years and showing them how they can triple and quadruple their business, but it's no longer their business. I bought it.
Love it. True capitalist.
In my case, Providence, good luck, had a lot to do with it. In 1980, I met Jack Nash. Some of you may know who he is. He's certainly a legend in our business. And he invited me after quite a few tests to come on board to Oppenheimer and Company. He was the president of Oppenheimer. And I started a journey at that point on the sales side with Oppenheimer and Kidder Peabody eventually, during which I was introduced to the hedge fund community. They were actually my clients. So for 13 years, I was pitching deals, ideas to Odyssey Partners, which was Jack Nash and Leanne Levy, Soros, Steinhardt, Wilson, Tiger, you name it, all the best guys. It was terrific back and forth. This is in addition to all the other great accounts. And by the end of '92, I thought, you know what, I think I may be able to do it by myself. I had enough capital. too much time was spent just marketing ideas. And I thought that I would have the autonomy and sovereignty to just pull the trigger on any idea that I felt was appropriate. And it was a terrific time as well, another providence. You know, at the beginning of '93, we had a terrific bull market, which was helpful. But my strategies seemed to work in bad and good times, and it was just an absolute joy. I started my first fund in January of '93. My second offshore fund was in '95. By 2002, we had way over $1 billion in 4 funds, and it was just absolute delight.
Thank you, Michael.
So at this point, I'm happy to share my experiences.
Yeah.
Michael is very humble. What he's not saying here also is, had you invested $1 million with Michael when he first started on his 7-year run, you would have walked away with $54 million. So this is all about making money.
This is not rehearsed, but thank you, Scott.
Deepak.
Firstly, I'm a little scared I got this right. I don't want to be yelled at. I am, like Troy, an engineer by training. I got my engineering degree in India, and I decided the world of finance was more interesting. I think engineering was great training. I made my way to New York, and I went to Columbia Business School, and I got my PhD there, and I studied finance, and from there I made my way to Lehman Brothers, and I worked there for 11 years. I worked in research, and then I worked in trading, and I grew up basically trading bonds backed by mortgages, home mortgages, by assets, by cars, by aircrafts, by student loans, and that's what I did both in research and trading. And then I said, you know, if I can do this for Lehman and make them money, why can't I do this myself? And I took a year off, and I set up my own fund, and that was 2002, and it's 17 years now that we've been in business managing money. I've known Troy for 17 years that we've worked together. It's been a great partnership working with him. We closed our fund in 2007 and gave 100% of the money back and sat out a year. And when you look back, you say, wow, how did you come up with that? Sometimes risk and reward in markets are priced in ways that it doesn't make sense to take risk. And that's what we felt at that time. We never thought the world would fall apart the way it did. But we basically relaunched our fund in 2008, and proud to say we just won an award for 10-year track record, best performing hedge fund over the last 10 years, just because we did not lose money in 2008. I think that helped us a lot. It's a fun market. I learned when I was in school that markets are efficient. Efficient market theory is what kind of is taught in finance, and my whole life has been spent basically saying that's not true. We can make more money than what you would make just investing in regular assets.
Thank you so much. All right, this is how it works. So I have a bunch of questions for this panel. Then maybe for half an hour maximum, if not less than that. Then I'll leave you to answer any questions you have for the panel. So it's very interactive. It's not just you sitting here watching us debate. You have the chance to ask any questions you want, as long as it's a question, not a comment. Those on this side can ask the questions here on this mic, those on that side on this other mic. And we'll go for maybe half a dozen or 10 questions maximum from you, and maybe half a dozen from me. So to cover all what we want to cover. There's no stupid question, there's no dumb question. Just make it short, and please, no comment, just your question. So the first question I have for the panel is, what's really your take on the current state of the hedge fund industry? I mean, why has this industry been out of favor since the crisis of 2007, 2009? I'd like Troy to start this, and then we can go as you always do.
So look, I think there are a lot of reasons behind that, but one of the principal reasons is that a lot of the challenges for what is still the largest strategy by far, long-short equity, are really are strategic or secular in nature. In that, if you look at long-short equity, you no longer have a short rebate. Remember the days of short rebates, right? It's much more expensive to short. There's no more information edge because of Reg FD, much more crowded space as well. And this massive trend from active to passive, at some point there'll be mean reversion, but in the meanwhile, most active managers have a value or GARP bias of some type, And so as money's pulled out of active into passive, value GARP sold down, and indices are bought indiscriminately, which right now tend to be dominated by growth. So that's making it very hard. The other factor is never-ending central bank intervention, right? Like, we're the first to admit pretty much every short you've had on since the bottom in March 7, 2009 has been a loser. The question is, how much have you lost, right? So we've gone through this extended period where assets just go straight up. And I'll tell from our experience, we felt like heroes last year because we were up, low to mid single digits, 90% of investable assets are down. And then here we go, the Fed's changing policy, right? They're going from hiking 2 to 3 more times to potentially cutting soon. And not only do equities go straight up, but bond yields drop like a stone as well, which partially causes that. So that's another reason why it's been much more challenging for hedge funds to generate competitive returns with equities. Then back, think about how well you did, or think about even how well Deepak did, the first 5, 6 years. So the way we've tried to adapt to that ourselves is focused on strategies where there's still inefficiency, where you can comfortably put up a high single-digit return with much less downside risk. Embrace what you are and what you can be, as opposed to trying to be everything to everybody, right? Because I think the hedge fund industry at one point was trying to be everything to everybody.
Absolutely.
Focus on what you can accomplish that's reasonable, rational. Understand that for some investors, they might be too greedy for you, or for some investors may be too conservative, or some investors might just want to have overseas exposure because somebody told them it was a smart thing to do. And so that's how we've tried to continue to have success and grind out that high single-digit return.
Thank you, Troy. Sam?
I wish I could agree with you.
Yeah.
But when an industry goes from 1.6 trillion to 3.2 trillion from 2009 to current, that tells me that we don't have an issue in an industry.
Well, if you care about performance, it's an issue.
Well, when you look at performance for the first quarter, performance was up an average of 7.4% across the industry. And when you look at healthcare, it's up almost 16%. If anything is wrong, the issue is who are the managers who are handling the money and what's the strategy they're using. So it sounds to me like an excuse to say, well, there's a problem in the industry. If there's a problem in the industry, you do something else. You move, you change your strategy, you find something new. You start working with new emerging managers. The cabal.
So what are you saying? The problem is the people?
I think the problem is the people in the industry, the strategies that are being used, but the industry is up. It's doubled its assets in a period of 10 years.
The industry's up in assets, but if you look at the performance, and don't forget you're quoting
performance sucks. The performance sucks.
So, I mean, this is what I'm trying to understand. Excuse me. This is a good point.
Yeah, yeah.
So
what about the 12 months before that?
Well,
so how can the assets double and the performance sucks? Explain this to me.
You have $3.2 trillion to allocate. What you need is you need to look for new ways to start allocating that money. The emerging managers make significantly more than the guys who are handling $5 billion.
So are you saying that the guys who give money to the hedge fund industry are not aware of what the hedge fund industry is going through?
I think they're very aware. I think it's a cabal. I think so many of them are dealing with pension funds and getting large.
It's like the follow mentality, It's like, yeah, we'll do hedge fund.
Yeah, let's
Unbelievable.
Let's be happy with 8 or 9%. I'm looking. When we spoke earlier this evening, you said you're looking for 15 to 25%. I'm looking for 50% minimum upside.
Got you. Michael?
Well, just to amplify on Stan's comments to your question. If your question is, why is the industry doing so badly, what matrix are you looking at? The fact is that it is verifiable, mathematically certain that the industry is doing great. If it's at $3.2 trillion, and it does not include private equity funds, the family offices, which very often have similar strategies where people pay for performance. When I started in the business, the industry was $100 billion. When Deepak relaunched his fund in 2007...
Hold on. Okay. No. Let's not confuse private hedge funds, family offices, private equity funds. This is not the same thing.
I'm not confusing it. That's why I'm addressing your question specifically, which is simply incorrect.
You're incorrect. The industry performance sucks. You're incorrect.
So what does it tell
People
you?
are in la-la land. They're giving money to things they don't understand just because it's nice and sexy to be in that asset class. They know shit. That's the reality.
But it's their money, it's not your money. Just like the market. When people look at the market, let me finish, Ziad. When people look at the market and say it's irrational, and many of my traders tended to do that, and they really would get us in trouble. The market is always right. And if the investor wishes to give the industry $3.2 trillion in spite of the fact that it's underperformed the market, then there is something extraordinarily robust about the business model. Now, what I hope we get to talk about eventually is why is it so, and we'll talk about the top heaviness of the business, where 90% of the assets, Troy will back me up on this, is concentrated among the top 10% of the managers. Therein lies an opportunity. But that is an entirely different issue, the performance relative to the health of the business. There is a terrific opportunity there, and that's why we're here, hopefully, to inspire you.
You obviously come from a marketing background. Sell, 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 sell. No. It's clear. It's very clear.
The extent that I lay some passion on it, it is because I follow my experience and my reason. If you have facts that contradict my facts, I want to hear them.
Listen. I don't need a ego thing here. If you're going to do this ego thing, get the out of here. Okay? Get it wrong. This is my show. Okay? So don't give me this thing. Okay?
Ziad,
No. This is it. Take it or leave it.
I don't know what you know about the hedge fund business.
I know about that.
So why don't you ask
listen to me. I make $100 million a year. Okay? If you make a fraction of that, then you come and challenge me. Have a nice day. Go ahead.
It's a tough act to follow. I would say, in my opinion, the performance of the hedge fund industry is mixed. There is the point that was made about asset growth is a very valid point. No industry doubles in size if it's a dud. You can have the best marketers for a period of time, but they can't sell it to you forever, right? And so the fact that the industry has grown tells you that investors are looking to basically this asset class to diversify their holdings. I think the performance, when you measure it relative to equities, has been terrible. I think that's totally the wrong benchmark. The word hedge funds means you're going to hedge. Now, many people, I think some of the problems have come because many managers have become too large and have been carried over to the dark side because instead of alpha, they generate beta, and they basically end up with kind of strategies that have high fees, asymmetric fees. You lose money, your fees are not as low as when you make money. With the asymmetric fees and the package beta, you get terrible performance. But benchmarking hedge funds to the last 10 years of equity performance, which has been spectacular, is a huge mistake. If I were to share with you, in my space, not just my returns, but the managers in my space, we barely lost money in any year. We didn't lose money in 2008. As a manager, not just myself, but the whole bunch of managers in my asset class, how can you benchmark us to equities? You want equity returns? I will get S&P futures. I've beaten LIBOR by a gazillion %. You want to beat the equity market? I'll put S&P futures on the side, and I'll get you S&P plus 20% over the last 10 years. That's what we delivered. And so it's a question of what you measure against, right? If they're truly hedge strategies, they have to be measured at cash plus a spread. I mean, there is liquidity. Your money is locked up, so cash is not the right benchmark, but cash plus a few % is a reasonable kind of benchmark. If you use that benchmark over the last 10 years, the hedge fund industry in aggregate, for all the mistakes it made, has actually beaten that index. If you wanted S&P plus, throw in S&P futures. You've beaten the S&P. Benchmarking to S&P, when it's printing 14% per annum for the last 10 years, it's a mistake. And the asset allocators know that. That's the reason why the hedge fund industry has grown the way it has, because the allocators look at this as a diversification play. They're like, I understand when equities go up, these managers are not going to make me money the way equities do. But will they protect me on the way down? And the managers that provide positive returns on the way down are the ones that win. And that's why the space has grown. And yeah, the concentration has created big issues. It created huge incentive problems where you're getting packaged beta with high fees in a lot of places. And that's for the allocator to figure out what they want to do.
Very insightful. Thank you, Deepak. Many strategists are today calling for a recession. What do you think, Troy? I mean, what's your view of the state of the US economy, China, Europe, recession, no recession?
Yeah, so probability of recession in the next 6 to 9 months, exceptionally low. It's been rather comical to listen to all these jokers. And I think a lot of these guys, and I would say gals, but I can't think of any example there because, you know, women are obviously wiser than men. But, you know, they need attention, so they go on TV and they say, yeah, recession risk, here it comes. And, like, it's exceptionally low. The U.S. consumer is still way too strong on every relevant metric. You look at debt to income, you look at debt to GDP, you look at how tight the labor market is, you look at wage gains. And so looking forward, in order for us to have a recession, you need the current slowdown in CapEx and the inventory liquidation to spread to the labor market, right? And there's no signs of that yet, because look at how low initial claims are, and just look at the JOLTS numbers. So if you look at the next 9 months, is there the potential for a recession in Q2 and Q3 of 2020? Yes, there is. Is it as high as it's been since the Eurozone crisis? Yes, it is. But a lot of things have to go wrong between now and then for that to actually occur. So despite much slower growth in Europe, bordering on train wreck type growth, and despite China trending down, we think the US economy is still in a very good place. And so from our standpoint, what we ought to focus on are risks tied to what we think are the strongest credit fundamentals in the US economy, primarily the consumer and also regional and community banks.
Thank you, Troy. Stan?
United States is growing at 2 to 3% every single year. President Trump, you'll excuse me, the greatest president in US history, is projecting a 4% growth rate. When you look at unemployment, unemployment is at about 4%, 3 to 4%. The Fed feels that 6.7% is an acceptable unemployment rate. So we're 50% or more under the unemployment rate that's necessary to sustain our growth. When you look at inflation, there isn't much inflation, there isn't much deflation. We're living in a Goldilocks economy. I don't see anything bad happening to the United States economy over the next year to 2 years. If anything, there's a trade war going on with China. In partial response to Ziad's question, that trade war, in the end, is going to help the United States, and I believe is going to help the rest of the world. We need to fix the imbalance in trade that we have with the second largest economy, the Chinese economy, and if you include all of Europe or the European Union, they're really the second largest economy. But Europe is not performing well either, but in Europe's non-performing, I think it's more an issue of governance and a problem that's going on in the European countries. It's not as bad as it's been in the past, and it's getting better, but still, I don't see any time in the near future where there's going to be a recession or a cutback. As far as China goes, China's growth has been cut dramatically. It's been cut dramatically by the trade issues that they have with the United States. China isn't growing. That does affect, some of our companies. It affects the technology companies who have their manufacturing done in China. I see China having some issues with its growth in the future. Good. Let them have issues. Screw them. But let them have these issues. I think the United States is going to continue to grow, and hopefully we'll see President Trump reelected in 2020, and I expect the United States economy will continue to grow. It's an opportune time for all of you to invest your money, because this is a growing country. Put your money in our country. Watch it grow.
Thank you, Stan. Michael?
I don't have issues with Troy's and Stan's comments on the economy. I think the underlying trend is that it's relatively stable, and that helps a stock picker like myself, because ultimately, if I look for some kind of reversion to the mean in a stock that I pick up that is mispriced, I want stability, because that's my exit. It may be via selling it to someone else, doing some kind of restructuring, some kind of IPO. So the fact that we have a relatively stable outlook domestically and offshore, I think, is a positive, and I wouldn't that wouldn't argue with your projections.
So I would say when it comes to the economy, I'm no economist, but when you're investing, you have to think about what are the various odds for various different states of the world. I would say I'm not as positive as Troy or Stan. I don't see the probability of recession being high, but I do see a probability of recession a year forward or 2 years forward, more likely than that. The Fed certainly has issues. They basically have gone from hiking 4 times last year. The market was pricing multiple hikes going forward, and suddenly they've done a U-turn, and now they're going to cut rates. And they're going to cut rates by a lot if they do. I mean, the Fed doesn't cut rates in like 25 basis points and stop. I mean, they think in increments of 1%, 2%, things like that. So there is certainly a bunch of guys out there who care a lot about the US economy, who acknowledged, and until very recently were basically thinking they need to actually slam the brakes, not actually start easing, but they acknowledge what's happening in the rest of the world. And there is issues in Europe, and there is issues in China, and I think the trade wars for the US economy are kind of chump change. They really don't do very much. It's kind of bad news for China, and I mean, it certainly impacts Chinese GDP a lot. For the US GDP, the impact really for a protracted trade war is from all the numbers I've seen put on by economists, it's not a big number. The one thing I do worry about, I agree with Troy, that the consumer is in pretty good shape. What took us into the last crisis was over-leverage at the homeowner level, and that's basically too much debt against housing assets which were not serviceable, and that snowballed and bad things happened, and Lehman went bankrupt, right? Really terrible things happened. That's really not what we have today, but we've had low interest rates forever, and when you hand money out for free, bad things happen. You just have to give it time, and if you look at corporate leverage, it's up a lot, and everything looks great so far. But if you just keep handing money for free forever and ever, it's a matter of time. It will come back to bite you one day. When that is, I don't know. I think the odds of recession are pretty low. I don't think, in the next 12 months, I would say the odds of recession in the US probably 10%. It's like a low number. But over a few couple of years forward, I think the odds are higher than kind of, it's not there's no odds there.
Hey, just Ziad, if I may jump in really quick. I love you.
Please, absolutely.
Just so everybody knows, I love Deepak. So, look, I'm usually tremendously constructive on the president's policies, and we've always said since he was elected, there's good Trump, bad Trump, and good Trump was tax reform, good Trump was deregulation, right? But there is bad Trump, which is protectionism, and I don't say that from a policy standpoint because I 100% agree it's the right thing to do. But you can't ignore the fact that CapEx has gone from growing 8% quarter over quarter in late 17 to early 18 to now being slightly down the last 2 quarters. And again, if you go back and look at the closest framework for this cycle, it's the late 90s going into 2000, where you had equities collapse, you had financial conditions tighten, CapEx went negative, then you had inventory liquidation. And so all I'm saying is you can't say that it's chump change, because if not for what's going on in trade, would have much healthier CapEx numbers and much healthier growth. And the faster you're growing, the more resilient you are to future weakness, right, by definition.
It's a fair point, Troy. I don't disagree. All I'm saying is how all these things come together. Trade is one part of it, but how all these things come together when you are in an economy that has been growing for as long as it has been growing, it is a matter of time that the law of averages will tell you that there is a shock that will come from somewhere. You don't know where it comes from, and maybe tariffs is the shock, right? Maybe trade is the shock, but there is a shock, and you just have to watch out for that. So my point was around the point of probability of recession. I think the probability of recession has gone up. If you look a year or 2 forward, so I don't disagree with you, CapEx turning, I agree, in fact, over there, that there are reasons where you want to kind of hedge the tails. And you can say the Fed, is going to do the best it can, but the tools that the Fed has is only so many. The tools that the other foreign central banks have are basically none. They have really, like Bank of Japan, what can they do? Right? ECB, what can they do? Just keep buying more bonds?
That's a good point, Deepak. Having said that, the Fed is under tremendous pressure to cut rates. What's your expectation, for future policy of the Fed policy?
I mean, Jay Powell told us he's going to cut rates, right? I mean, he's just telling you loud and clear that he's going to cut rates. And when the Fed moves, I said it earlier, they don't move in 25 basis points. They may move 25 basis points a meeting, but to change 25 basis points is nothing for the US economy. To make policy actually be effective, you got to move in units of like 1s and 2s and 3s. So if I had to guess, if they cut rates, they're going to cut rates by 1% over the next year.
How much?
1% over the next year. That would be my guess, because I think that's the unit the Fed works in.
Troy, what do you think?
You know, I got to take the other side of that, Deepak, again.
Okay.
Yeah. So sorry. I think it's 25 to 50, and it all depends on how much the Fed, Trump and G, whether or not they can cut a deal. The consumer holds up, and then at that point, CapEx explodes, right? Because accelerated depreciation is going to, after 5 years, it starts to step down, right? So the clock is ticking. There's another clock ticking, and that's policy change out of DC.
Yep.
Right. So people forget, but you know, everything on taxes is done in reconciliation. There is a non-zero probability that 2021 Democrats have the House, the Senate, and the presidency. No. What do you think is going to happen to tax reform then?
Never.
Not good. Ain't happening.
No.
What's that?
No.
Never happened. Never happened.
I don't agree. Not happening. Same here.
Hey, whatever.
But I mean, I understand.
Yeah.
I understand.
No, but what? Look.
I don't think it's happening.
All right, Doug Jones is toast right in Alabama, but McSally is going to lose her seat, right? That she was appointed to twice, basically. Gardner's vulnerable. Tillis is vulnerable, and because Kobach's running to Kansas, the Kansas seat's up.
When was the last time that a president who has an economy that's growing at the rate of the United States is growing, that he was thrown out of office?
I'm not saying it's going to happen. I'm just saying it's a non-zero probability. Yeah, that's all I'm saying. Yeah. I mean, I deal in probabilities, not in certainty. Let me get that straight.
Thank you.
Thank
you for stirring.
Ziad, what this all comes down to is it's wonderful that we disagree. Why? Because the economy has a certain degree of instability to it. Yeah. And instability always equals opportunity for an investor.
That's right. Brilliant.
Right? Yep. Let's find what strategy works the best. In my case, I'm in the education vertical. If the economy goes up, the education vertical does well. If the economy goes down, the education vertical does well. You look for that instability. You look to find where there is instability so that you can invest your asset in that instability and make money. And that's what this is all about. We're here to make money. So I'm glad that there's going to be question about what is the Fed going to do or not do, whether they're going to cut 25 base points, or whether Trump is going to come in and scream and yell. Lovely. I love it. Instability, give me all the instability in the world. We'll all make money.
So let me ask you, look, the hedge funds are definitely facing lots of challenges. Whether performing, not performing, that's debatable.
No, they're not. Everything's great in the hedge fund industry, right, guys? Okie dokie.
Okay.
I wish that were
so. Whatever people say, they're performing, not performing. How are they going to justify their expenses, their expensive fees, when the stock market is doing so well? Just tell me, how are they going to justify this? I mean, I don't understand how it tripled, doubled in assets to 3.2 trillion with all these fees. This is going to be going on like this?
You asking me again?
Yeah.
These guys
are
wildly bullish. No, the hedge fund, not criticize you, but the hedge fund industry has responded. Look, fees have come down in asset management. I mean, there's tremendous fee pressure. The average fee we pay now is about 1.11 and 12.6. If you look back 7 years, it was 2 and 20 or 1.75 and 20. Now, that's not exclusive to everyone. You're right, there are small niche strategies that can still command full fees where you have higher return prospects. But in reality, look, you can only squeeze so much juice out of a squeezed orange, right? And rates are very low. Markets are fairly efficient. We've had free money for years. So in an environment of lower returns, right, and let's not forget that even though equities are up this year, they were down last year, and even though hedge funds are up 7 and change this year, they were down last year. In that environment, you have to respond with lower fees. You have to be commercial if you want to protect your base.
I don't agree with you. No. Right?
I'm getting that trend.
What I hear you saying is we're not performing, and because we're not performing, we're going to cut our fees. So perform. Right? If you make 20 or 25%, and a client comes to you and he says, well, Troy, I'd like you to cut your 2% fee down to 1%. You'll say, screw you, get the hell out of here. Right? There are many people who want to hand me money to get 25%. So perform, and you don't have an issue. As far as
if so many people are handing you money, why are you here?
Well, because I'm a beginner in this business. Right? I'm a small fund. I'm not managing $5 billion. You know,
Okay. Right.
When you're managing, you know, 15 or 20 or $30 billion, right? But a Shaw still produced 15% return. I mean,
Trying to raise money
yeah.
to make money for investors, right?
Yep.
Yet everything in this $3.2 trillion industry is great, and you're managing $15 million.
Yep.
Okay, I'm with you.
You know, again, the smaller manager makes money and doesn't have to cut his fee, and the larger manager who isn't making money may have to cut his fee.
Okie dokie.
What do you say, Michael?
Well, ladies and gentlemen, the fact is that when you're dealing with a client, and I had several hundred investors, average was about 5 million per investor. I've spoken to literally thousands of potential investors. Very rarely does an issue of how does the rest of the hedge fund community do at any given time come up. They want to know about my objective, which we're trying to line up. In my case, it was always unabashedly, I'm trying to make as much money as I possibly can without losing, because I'm by far the largest investor here. Secondly, I have a strategy that relies on bottoms-up approach, so I'm not an economist, although I am sensitive to what's going on in the economy. You have to be patient. You have to be patient, find the right ideas, which are rare, and then make sure you can couple them with a catalyst. And when you have 50, 70% returns, the fees are never an issue. As I mentioned earlier, at a 50% performance fee in one of my funds after we beat the S&P 500. In the other ones, it was 2 and 20, and I can assure you that with most of the sort of iconic hedge funds of the 80s and early 90s, that was also not an issue.
Yep. In the 80s.
So if you have the capacity discipline, which is, as you know, one of the most important due diligence questions that you can ask, how much can you comfortably manage in this strategy? Deepak had the capacity discipline. I sent back $600 million. I didn't feel I could do justice to it. And I was harming myself in the process when the performance was compromised. So you react to the situations, and all you do each day, you look for those specific ideas that have somehow deviated from what I believe to be, I hate to use the intrinsic value phrase because it is so misused. The best one is probably private market value. That's why I mentioned stability in a market being important, because I usually try to sell it to someone who's stable in the same business as Stan does. You find a company that's doing well in educational business, and they'll tell you how much they'll be willing to pay for whatever it is that Stan is looking at, and if there is a substantial gap, then you have a pricing inefficiency. Yep. And then you couple that with a catalyst. In Stan's case, he actually goes in and helps them eventuate that catalyst. That is the value added that you look for. The $3.2 trillion is academic, other than what I mentioned earlier, that people apparently are comfortable with the idea of paying for performance. Hallelujah. What's wrong with that? What could be more capitalist than that in spirit?
Right.
In fact, why don't you raise your fees? And in fact, you didn't get 20%. In some cases, you made 50%.
Yeah, and it was honestly, originally when we started, it was 1 and 20, then we went to 2 and 20, then someone came and says, I'm going to give you $50 million. I said, I don't want it. I'm closed. Well, I'll give you 2 and 25. I'm the only investor. Okay, we did that. Then someone said, you know, we're having problems with our hedge funds beating the S&P 500. And I agree with Troy and Deepak. It depends what it is that you look for. Deepak does something else in terms of objectives than what I did. But if you look for optimal performance and they're still lagging, you tell them there will be volatility. If someone doesn't want volatility, don't come to us. I will explain. You have to disclose to everyone that if you hope to be up 50 or 70%, you'll have volatility. Hopefully most of it on the upside. But even in the years when we were up triple digits, we had 3 or 4 down months.
Thank you, Michael. Very good. Very insightful. Thank you. Deepak.
So I think hedge fund fees are like anything else. There's a market out there, and the market clears. And when there is demand, fees are high. Our first 5 years, we were printing money, and Troy was an investor, and I didn't cut fees for one investor. Only one investor, actually, I cut fees for, Troy. He gave us a lot of money, and it's actually a fact.
That's why I love him so much.
I'm telling you.
I totally love him.
I think to his credit, when we were printing money, he was our largest investor, and he was all in, and that qualified for a fee cut because of the size that he had with us. But there was not one investor we cut fees for. In fact, I'd say, life to date doing this, I don't think I've lost one investor over fees. Because you calibrate, and hedge fund managers calibrate. And when your returns are not high, you basically have to, and equities are doing great, well, you have to calibrate and say, you know, I can't charge you 2 and 20. Equities are making 14, and we're making you like mid-single digits. Like, how are you going to pay us 2 and 20? You just have to cut fees, right? If you're in the cycle when the equity market is struggling and the hedge fund managers are actually prospering, if your strategy happens to be one that does well, you can charge fees because now you're adding real value. And so I think the fee decline that has happened is a very natural market clearing mechanism where equities have done great and hedge fund managers have had to cut fees. Yep. In a different environment, they can raise fees.
Yeah. Okay, listen, I have one last question because I want to give room to the audience. So what do you see as the biggest risk to the hedge fund industry today? Just to sum it up.
I think it's mediocrity, right? In that, you know, as the assets have grown, so much of it's gone to the larger players, and there's a acceptance of lower outcomes. That being said, it's still it's a dangerous time in a cycle to have a lot of risk strapped on. So I understand the risk-averse nature, but you know, making 2, 3, 4% returns and charging high fees is just not going to happen.
I agree with him.
Hallelujah! Hallelujah! Yeah.
Look, Stan. At the end of the day, if 2 people agree on everything, one of them is not needed.
Yeah. That's right. That's right.
So that's fine. Disagreements are
it's
fine.
Good times, man. I actually, you told me this is going to be fun, man. You told me this is going to be different, and you weren't messing around.
Exactly true.
The greatest risk that I see is that investors will not have an opportunity to find those hedge funds that are performing the best. Right? The ones that are performing the best also may not even take those investors. As Michael and Deepak give back money, right? So they're not interested in everyone's business. So it's really difficult for you to search out and find, well, who's performing? You're certainly not going to the biggest ones because they're not going to take your money. So you have to search out who are the smaller hedge funds that are managing under $1 billion, who are getting the 25, 50, 75% return, while at the same time minimizing risk. So there's where I see the biggest issue is not being able to identify who's going to perform for you and where the opportunity is.
I want to hear from Michael. Michael, what's the biggest risk with the hedge fund industry?
Well, it depends what you mean by risk. If it is, again, the size of the industry at $3.2 trillion, it may be the sort of mediocrity that Troy talks about, increased regulation. But I tell you, if you have a hedge fund that has a value added to the client, you can do all kinds of things. You can transition to other structures. 3 of my 4 hedge funds were offshore. There is a preference to be offshore as far as domicile is concerned, given a choice. But I think the idea of paying for performance, the comfort that the client has is here to stay. And even if the 3.2 trillion diminishes, it's still not a problem for the industry.
Deepak?
I'd say 2 factors. The first is size. I think the hedge fund industry is too large. There's only so much alpha you can generate. And so what you get is package beta. And the other is the equity market. I think the equity market is actually 2 risks. One, if it just keeps running the way it is, I mean, if equities are up 12, 15% every year, I mean, hedge fund managers are going to be branded the guys who charge high fees and generate no returns. Yep. They will be the ones who will be hiding in cocktail parties in corners and not be wanting to be seen because they underperform the equity market and charge high fees. The flip side is there's so much package beta that if there's a serious equity hiccup, there's going to be a lot of hedge fund managers that are going to be carried out on a stretcher. And I think kind of somewhere in the middle is really the sweet spot for hedge fund managers, where if equities start delivering returns that are, cash plus premium, 5%, right? That's a much more kind of normal environment where now strategies that truly are hedge strategies that can generate some decent returns have some value in a portfolio. And the risk is, you know, the big size is a problem, and equities, you know, either too high or too low is a problem.
In my humble opinion, I think it's hubris of the fund managers who believe they are gods, masters of the universe, that they can control everything. Absolutely. And you know, I mean, you make the hedge fund industry like if they are so good, so untouchable. No, it's not. A lot of them are a bunch of idiots who just happen to have a position there, who happen to have somebody raised money for them. They give them this pool of money. Go and do it. Absolutely, absolutely. You disagree? I disagree. This is why you're there.
I don't know how much money you managed in a hedge fund, but I don't recognize that reality.
Doesn't matter how much money you manage. It can evaporate very quickly.
In hedge funds. The fact
it can evaporate very quickly. It doesn't matter how much money you manage. It's not the size of how much you manage makes you successful. It's not the size. I mean,
the idea, if this is capitalism, the client makes the decision. You make a full disclosure in terms of objectives, in terms of strategy. You show him your record, your credentials, and if the client is on board, including paying the fees, he or she will be on board. But it's up to the client. Don't insult the clients. It's not up to the just hedge fund managers. No one puts a gun to a client's head and says you must invest.
Who's insulting the client? On the contrary, I'm not.
It's hubris on the part of the manager.
The fund managers, not the clients.
And if the market bears 50% above the S&P 500, take it. I thought that was your philosophy.
What's that?
I thought that was your philosophy.
Which is?
Free market.
Yes, of course.
Market is, well, what is it? What could be more free market than paying for performance?
I don't want to regulate the market. I'm telling you what's going to be the downfall of the market is this. It's the same thing as all the unicorn in Silicon Valley. You have over 300 unicorns. Same story. Hubris of the venture capitalists, of the companies who run these entities, of the management who runs these entities. It's hubris. Whether this or that. That's what it is. People get drunk in the head. Look, I don't know when is the last time you managed money, okay? You may be a very good theoretician. You know about the hedge fund industry. When is the last time you did that? People's success goes to people's heads. And this is how they start making major mistakes. And this is what's happening. And this is what could happen. The people, they're always latent in getting access to the information whether they're going to invest in this or that. I'm not blaming the people. I'm blaming the fund managers doing that. It's not the people. You cannot control the people. It's the market. It's the fund managers who are going to make it hell or heaven.
Ziad, you're right. There are a lot of big egos in the hedge fund business.
Oh, yeah.
I'd say the flip side, though, is there have been they've been humbled a lot. If you look at the biggest names.
Because they've been humbled.
By the markets. In the end,
exactly.
The market is the biggest humbler.
Exactly.
Right? And you can, I mean, we can go over the names, right?
That's why they're still
the stars.
Exactly. And this is why they're still in business. Exactly. Exactly.
You got to get kicked in the teeth a couple times and hopefully not blow up.
You learn from your failures, like he was saying, not from your successes.
What could be more humbling than 6% return?
Well, here's one for you. I was thinking of this because this is one of my favorite examples that I was talking to, I think, one of Deepak's guys about. So talk about hubris. There was a group of guys that came out of, I think it was Goldman in London, and they were so convinced that the housing market was going to melt down that they shorted subprime. So it was like somebody gave them money. They were the right team of people at the right time. And it wasn't all luck. It was skill. But look, if you put that short on 2 years later, you would have lost a lot of money waiting for it to happen. And so, again, they made a ton of money. They were in magazines. And guess what they did? They went extremely levered long the same market they were just massively short within 2 weeks. You know how long it took for them to vaporize? You make 500%, you lose 100, you still got 0 left, right? So there are countless examples of people like that over time. Fortunately, not in this stage, I hope, right? But you know, you gotta get kicked in the head, right? Kicked in the teeth. That's a learning experience, learning from your failures, and you just gotta make sure when times get tough that you protect capital well enough that you can survive that, right? And that's the problem. When you have too much hubris, you won't survive it because you're taken out in a body.
Exactly. Thank you very much. Okay, please go ahead.
Hey guys, great talk, learned a lot. I just wanted to say you do need positive correlation to risk to make money. Anybody who invested in the market after the last financial crisis did fairly well. Managing capital, I think personally at different capital notional is different risk taking. 100 million strategy is different from a billion strategy, is different from 100 billion strategy.
Size is hard.
Very true.
So what could work for one doesn't work for the other. But, you know, just Troy, you kind of mentioned about the interest rate. I've been kind of following that as well. I think Fed plays a more important role what's going to happen with the economy than the president does. Mm-hmm. So if you look at a matrix chart of all the yield curves around the world, U.S. is the only one that's green from short-term to long-term in duration. They actually have dry powder left, where they could now re-engage that cycle that we did. So my question to you is, one, right now there's a shortage of funding for pension companies, for all the baby boomers that are retiring, 2011 to 2029. They're all gonna start hitting retirement. They're living much longer. They didn't anticipate this in the pension model. So they need some form of returns, and pensions haven't been getting that return because most of the fund managers, they just put it into like T-bills and packaged up beta. They haven't been getting alpha even though the market has kind of gone up. So my question to you is, if the Fed does give in and Trump does get what Trump wants, if the Fed does give in and starts to now lower the interest rate, and do you think for the next election cycle, there might be a roaring 20s again, where they introduce loose monetary
bubble like
policy?
90s? Or bubble like 90s?
No, like the
in terms of
1920s,
growth?
like how we had the roaring 20s, like where we get loose monetary policy again, what happened in 2009, more printing of the money. This time, we don't care about the world, we care about protectionism, so let's make America great again. The Fed is on our side. The commodities, like it's US dollar is a reserve currency of the world. The biggest experiment happened in the last decade. The West printed, the East austerity. East had to do austerity because they're not the reserve currency. The West doesn't have to do austerity because they control the reserve currency.
Okay. Let's answer his question.
So
this is becoming a comment here.
Yeah. So question, look, if you look at the most rational bull case for the economy as well as markets, and you say, the way things are lining up now, it's Greenspan late 1990s.
Yeah.
Fed cuts 25 to 50 basis points, right? Just to make sure that we don't tip over, right? Money supply is already growing at like 8.2% quarter over quarter. So it's already exploding even before the Fed cuts. You start to see inflation start accelerating, growth start accelerating, and then Trump and Xi cut a face-saving deal for both of them. Because they both need it ultimately for different reasons. Yeah. That's when you're back off the races. That's the point I was making before is, look, consumers in fantastic shape, right? If you get CapEx coming back, right, business confidence back up to levels it was, now you're talking 2.5% to 3% growth again, right? And that would be as good as it gets in not the roaring 20s, but the roaring 2019, 2020. Okay? Yep. So I hope that answers your question.
So positive correlation to real estate, gold, and equities?
Well, again, so gold's a trickier one, man, because gold is more of a bear case play, right? So to me, you know, if you get that pop up in growth, then that means the Fed comes back in play, and you're not going to see. And that's where I disagree with people that say that the Fed's got to move and it's got to be 100. Like I just don't see that. Like I think if you get that 25, 50 basis points cut, and then you get growth rebounding, then the Fed's back in play, and gold will stay sideways for quite some time. I'd be long equities, long real estate. In our case, it'll be debt tied to real estate. Yeah.
Thank you, Troy. Go ahead.
Hi. With the pending normalization of the yield curve and possibly steepening of the yield curve, as Deepak says, there'll probably be 4 declines in interest short-term rates by the Fed. Then you're going to have a very steep yield curve, which is going to basically portend a tremendous acceleration in CapEx. I also think that if there's no agreement with China, that's also going to accelerate CapEx because there's going to be some movement of industry back to the United States. So between the steepening of the yield curve and the possibly, most likely, no deal with China, I think our CapEx is going to skyrocket over the next year or 2 or 3. And as a secondary
Excuse me, what is your question?
Isn't that what we just said, though? I mean, did I miss something?
No, so my question is, how would the hedge funds be viewed relative to the broader market indices when you're in an environment where you'll have probably a sustained period of steep yield curve, tremendous growth in CapEx, and I think the benefits of the tax cuts will kick in, are even going to accelerate over the years. So as a hedge fund, you're going to be judged more relative to the broader market indices. And if that's going to be back to, let's say, another complete new cycle of growth, how does that portend with the industry's growth and their prospects? Because I think it seems to me that that's a very major challenge, your comparison with the broader market. And I think that gets even worsened with the sort of, with the steepening of the yield curve particularly. And I think the China issue, I think that actually is a headwind for the hedge fund industry. And I just was wondering what your thoughts were.
So you're really into the yield curve, right? That I got. No, great question. So look, again, there are different assets that investors invest in, okay? Equities are one. Let's assume investors put some money in something other than equities. Hedge funds should do much better than bonds, high yield, and IG in that situation, because look at how tight spreads are, and look at how low rates are, right? So if you look at, in that scenario we're painting, the booming 20s, or 2019, 2020, 2021, look, rates are going higher. That's going to be very problematic for fixed income. And spread product, usually when rates are going higher, you have stronger revenue, stronger growth, less credit risk, but spreads are already so tight, right? So I think in that environment, the reason you're allocating to hedge funds is to admittedly underperform equities, but to do materially better than fixed income, high yield, and investment grade credit.
Okay.
Yeah, but relative
No, enough. That's it.
Okay, can I just give a perspective from a hedge fund manager that actually has to generate alpha? I mean, this is a very reasonable question, but if I were to pitch that scenario, assuming I agree with you completely, then Troy would say, well, but how much of it is already in the market? It's tough to guess. And let me say at the risk of offending some people, but that is the reason why there is such mediocrity in performance. People are just guessing. Maybe this will happen, maybe this will happen. That's no value added. It's tough to raise money on that. You have to find something very specific that you know is mispriced today, and your understanding of the macro should be there, but only from the point of view of stability. Okay, I can get out with this piece of crap, and very often it is crap, as long as it doesn't go out of business. It could be a terrific investment. So understand that, and I reflect to you my experience from catering to these great hedge funds of the 80s and early 90s, because they would throw me out of the office if I started to talk about the rates and things like that. And even the great economists couldn't do that. You have to give them some value added. What is your age? What is your variant opinion? What is really contrary that the market doesn't discount at any given point? And the smaller you get, that's why I like Stan's model, the smaller you get, and if you can couple that with an activist perspective where he can become a catalyst in getting the revaluation higher, that's how you make it a double. And I would always say it's at least a double within 12 months, or 50% within 6 months, even better. But I won't tell you, well, because it's cheap or expensive and it's a short, but this is why it's going to go up. And it could be a relatively expensive stock that I'm pushing on the upside, and a fairly cheap stock that I'm shorting. There has to be a reason why.
Thank you. Go ahead, Tim.
Yeah, let me shift gears just a little bit and ask the question that I'm sure a lot of the people in the audience want to hear because they want to make obscene money like Ziad does. Okay, so I've got brilliant trading strategy. I mean, suppose I have a brilliant trading strategy. I want to be a hedge fund manager. I've developed a track record, and I come to you guys and say, hey, why don't you put some of your hedge fund money in me? How would you guys evaluate that? What would you be looking for in order to make an investment like that?
So you want me to take this? Is that
I'll be happy to address it.
Yeah, you start, yeah.
Well, again, I had to pitch to lots and lots of people. So you begin with an objective. That is a critical issue. Fully disclose what your strategy is going to deliver, you believe. And then it has to be rational. You preferably have real experience in business. Hopefully you have a record, like Deepak and myself, before we started the hedge fund. But there is no magic about it. It's really a lot about common sense, reasonable intellect, but you don't have to be a genius. And, you know, don't tell us stuff like you think, well, Bitcoin is going to go up because it went up, you know, for the past few months. Maybe yes, maybe no. It has to be more rational than that. The best pitch that I ever had is, look, there are two markets for any asset. One is the public market in which I buy the stuff. The other one is a private market. It could be a financial buyer, it could be a strategic buyer. But if I see a big cap and I know I can take this asset, which is a very real company, maybe losing money, but there is a real asset, and I can sell it to that strategic buyer. And I know that strategic buyer, I talk with them. So they verify my opinion. Then you really diminish your risk. And I can show how the potential seller benefits, and I can show how the potential buyer benefits. That is how you create real value. That's when the investment banking experience comes in as well. That was helpful, not only as an analyst.
Thank you. We have to move to another. We have a lot of people here. Go ahead.
I think everyone here on stage has heard of Ray Dalio Bridgewater.
Yes.
Given his track record.
He manages quite a bit of money, I think.
Yeah, just a little bit, right?
A couple nickels.
So given that context, he seems to be a big proponent of algorithms. And over the horizon, looks like AI is the maybe logical next step as it relates to that. So can you speak to the role of algorithms and the potential role of AI going forward?
Deepak, you want to take that one?
Yeah, firstly, when you talk about Bridgewater, I would say if there's one person who's been touched by God, it's him. You don't make that kind of money with that kind of assets under management just out of algorithms. It's spectacular. I mean, it's a spectacular success. But to answer your question, yeah, of course, it's a given. I mean, technology, if you're not going to embrace technology, you're going to get left behind. You know, AI is kind of, it's a fancy word, AI, right? What is AI? At the end of the day, you're going to use data, right? And you're going to use data to extract information, and you're going to use data to extract information and extrapolate and try to come up with what's going to happen going forward. That's what you got to do for a living in virtually any area you're in. There are a few areas where it's actually operational expertise that will generate the returns. But as investors, yeah, I mean, you just have to analyze the data. I mean, we look at, it's looking at data on millions of homeowners, what they do, million of car loans, what do they do? What is the law of large numbers? And now how can you take this historical data and try to figure out what's going to happen in the future in different rate regimes, in different housing markets? Is that AI? It's using data to figure out, right? Building intelligence. That is a given in virtually any industry that you're in today. It's the nature of where you are. If you don't, you have to do that first. Now you have to bring in the subjective element. You've got to arm yourself with all the analysis, and on top of that, you'll layer on your experience, right? Your domain expertise. And that combination, if it works well, that's the magic.
Thank you, Deepak. Go ahead.
I hear a lot of different ideas about investment, but what I don't hear is, have you guys come to any assessment on the value of opportunity zones, investment in urban America?
Great question, man. Great question. So we actually have an opportunity zone fund, just a little commercial for that out there. And so, look, we were partially involved in the construction of it through one of our partners, Senator Scott from South Carolina and Cory Booker were obviously very critical. You look at it today, the biggest challenge for opportunity zones is, did the government bribe people enough? Right, because we haven't seen much take-up. It's really, it's frustrating, right? There just hasn't been enough people deciding, you know what, I'm going to harvest, or I'm going to take a profit, I'm going to roll it into an opportunity zone, I'm going to let it ride for 10 plus years, I'm going to get tremendous tax benefits, but the whole OZ thing sounds like risky, even though it's not. So that's the biggest problem. But the opportunities are tremendous. I mean, the properties we've looked at, and I'll tell you the types. Hotels are best. And you say, hotels, what's up with hotels? That's where you create the most jobs. So the politicians that created this, what they want to see at the end of the day is job creation and the area median income uplifted by meaningful amounts. So hotels are best, right? Probably logistics second in terms of job creation as well. And then you get into mixed use retail and multifamily. Dovetailed in that is the fact that there's a workforce housing shortfall in this country. So that's arguably has the best supply-demand dynamics by far for CMBS right now within multifamily. So yeah, we think there's tremendous opportunities. Realistically, you're looking at probably 8 to 10% conservative non-tax advantage returns, IRRs, and with the tax benefits, somewhere between 12 and 14.
Thank you, Troy. Nina?
I'm going to be short and sweet as requested. What's your point of view and strategy on crypto, please? Since we talked about Bitcoin and it looks like there are so many lovers for instability and volatility on the stage. Thank you.
Was that on cryptocurrencies?
Yeah.
I want you to go look up a guy named Nouriel Roubini. And I haven't agreed with him on many things over time, vehemently, but I agree with him completely on it.
He's so much against cryptos.
Yeah. That's where I sit on the spectrum.
He's Mr. Doom.
And this includes Bitcoin, I assume. I just want to clarify because many people confuse, right? Like blockchain, Bitcoin, and crypto.
Yeah,
so
blockchain, again, a glorified spreadsheet. I mean, decentralized record keeping. Like, okay, is that like the greatest thing mankind's ever seen? By no means, right?
Okay, interesting. Okay, I would love to hear perspectives of everybody else, please.
Well, the cyber currency, I think, is very interesting, and it's if you like, we could chat afterwards. I think what the cyber currency needs is some kind of a major sovereign behind it.
Seigniorage is the term, yeah.
Potentially with maybe even gold backing. So if you have China, India, Russia getting together and backing a cyber currency, that would be very valuable. But it's difficult to call something as dramatically volatile as Bitcoin a currency, because it's not a storage of value, which is what a currency should be. Whether it goes up or goes down, that in and of itself, I think, is fatal defect to something like Bitcoin.
So you don't consider Bitcoin as a store of value?
It's not a store. I mean, obviously, you cannot have something that goes from essentially 0 to 20,000, back to 5,000, now it's at 12,000. That is not store of value. It's a speculative vehicle. I know that there are hedge funds that, I don't want to say invest in it, but they speculate in it. And I have nothing against it if you put 5% of your assets, but to call it a store of value is a stretch.
Two keys for a currency: seigniorage, store of value, right? It's got neither.
Okay.
Anyway.
I mean, if I can add, I would just add that I would join the negative camp simply because who buys Bitcoin besides speculators? It is people that want
Silk Road, man. The Silk Road.
Yeah, and like number one. Number two, its value is measured in US dollars.
Right.
How is it a currency? You're judging Bitcoin's success in US dollars. The currency is US dollars, not Bitcoin.
It was created after the financial crisis, so it is a positive correlation.
I mean, anyway.
Okay, go ahead, please.
Too.
So on the topic of hedge fund fees, there was a lot of discussion about beta and overpaying for beta. So specifically, and this is for the panel and also for Ziad, how much would hedge fund performance be improved if the industry adopted something that looked more like a private equity style compensation standard, clawbacks and hurdle rates that are appropriately geared for the strategies?
My own feeling is, again, I went through that issue where the clients came to me and said, look, we'll pay you 50%, but we want to have a hurdle rate of S&P 500. And I like that. I think if you look at if you go back to the original hedge funds, including Warren Buffett's original hedge fund, it had a 7% hurdle, but then he took 25% of profits. You would force hedge funds from being essentially leverage beta type of players when you do that, or closet indexers. And it's one of the reasons why we have several of these trillion-dollar companies, and the risk is very concentrated among them. So I would be very much for having a hurdle rate.
Thank you.
I would love it if I could raise private equity money with 10-year lock with a hurdle. If you look at private equity over the last 10 years, I mean, it is the hot thing in town. Any pension fund manager you speak to, what do they love?
Liquid and private.
Yeah, is they love it. You know why they love it? Because there's no transparency and there's no liquidity. If you look at last year, the fourth quarter.
And they don't mark to market.
Yeah, there's no mark to market. They were basically high-fiving. I went to many conferences where the pension fund managers were high-fiving how good their private equity performance was. The one thing that was up, no, you're not going to market to market. Of course it's up, right? And I would love to have that money. Our 10-year track record, I will put up against any private equity manager. Unfortunately, as Troy alluded to earlier, we did great in the first 5, 6 years. We didn't do so well in the next few years. We made money, but not as much as we did in the first 5 or 6 years. You look at my 10-year track record, our 10-year track record is 21% net. If I walked in somewhere and said, hey, we made 21% in net, no liquidity, we don't want to tell you how we made the money. Do you want to give us money? We could raise a ton of money if we were private equity. Right? Providing liquidity and providing transparency should not be a reason to basically have to charge low fees and manage less money. The private equity market has actually underperformed. I'm sorry to knock them if there's anybody here with private equity you work at a firm, but private equity has underperformed public equities.
A lot of people have private equity fundraising envy right now. You know what I'm saying?
It is the new bubble in town. Lock the money up for 10 years. Over the cycle, we will make you a lot of money. I have no problems with the hurdle. It's pretty hard to do that when your strategy, the underlying assets are liquid. Like, why do you want 10-year lock?
Thank you, Deepak. Two more questions, and that's it. Go ahead.
Quick question. Since someone mentioned that hedge funds should be compared against cash plus spread as opposed to S&P 500, which, by the way, was very insightful. Do we have any record of how they have performed when the market was not doing well?
Over the last 10 years, hedge funds have, if you look from 2008 included, they probably generated cash plus a spread, 100, 150 basis points. 2009 onwards, probably it's been maybe cash plus 300, 400 basis points. And that is the industry in aggregate. It's not been very impressive. I would say it's been okay. But it's not, comparing it to, the S&P up 14 and hedge funds are up 5, 2009 onwards, and saying, hey, what have you done for me? Well, cash was 0, so you haven't done so badly, right? This question is also how risk managed are the strategies. You can't really compare something to cash when it's going up and down 10%, right? That's a different kind of volatility profile, right? So cash is the wrong benchmark.
Okay,
thank you. Go ahead. Last question.
This is an open-ended question. So on some level, you have to predict the future a little bit in this business, right? You have to think about why a stock goes up, why a stock goes down. So the question is, has your paradigm shifted in the last 8 years? Like, are you looking at the market differently now than you were before?
Of course. Look, like I said before, I think you have to go where the inefficiencies are, right? Where there's structural inefficiencies. A lot of that's due to the deleveraging of the banking industry since the financial crisis. People don't understand, but after Glass-Steagall was repealed, bank ownership of pretty much every fixed income market in the world went from 5% to 25 to 27%. Banks were huge participants. Right. They're gone. They're only market makers now. So what that leaves are, in our opinion, attractive high single-digit, low-teen returns with very little risk. And then you have to avoid strategies where a lot of the challenges are secular and not cyclical. And I think you would agree, for most long-short equity managers, outcomes have been far worse the last 8 years than 2000 to 07, and certainly than the 90s, right, where there was tremendous inefficiency.
Thank you.
You would agree with that, right?
Are you asking me?
Of course, yeah. I'd be shocked if you didn't, but yeah.
Well, the long side became very politicized. It seems anytime there is a trauma in the market, it's a political decision to let's flood the economy with liquidity, and the market always bounces back, and this is how we got this 15% annual appreciation since the last catastrophe. So again, it's difficult to compare it with that 15% as opposed to historically, which was 5% plus cash. But within that universe, it became much more globalized. So as of 2007, 2008, I started looking at the world much more so than I did before that, which was strictly domestic. So again, as I said on the outset in my comments, I have never seen the opportunities as plentiful as they are in this market, including the would-be clients' willingness to invest in hedge funds if you have some value added, even more so.
All right. We're done. Please, Alexander.
A friendly question, right?
No discussions. So you return the money to investors at some point, 100% or 600 million. What would make you do that again in this environment? And can you let me know when you do that?
The 600 million I sent back to investors was a fraction of what I managed because I didn't feel I could accommodate it and do it justice. There was $1 billion plus remaining, which I felt I could manage effectively. So if I ever decide to come back and manage actively, first of it would be my own assets, first and foremost, as it usually should be. And then I would almost have a family office type of structure, or multifamily, where I would have, instead of 250 clients, I would have maybe a dozen clients, but with each one maybe 100 million minimum. And we would really understand what it is that we're trying to do. Complete transparency and complete freedom to do what I think is right, as I did the first time. If you look at my PPM, there was a certain focus, but at the end of the day, I had the right to do what I felt was right. And that's the essence of what I think hedge fund entrepreneurship should be all about, and why it's such a great business.
Thank you very much.
We can talk afterwards if you like. I'll stick around. We can continue. And
I'd like to finish with some closing remarks for each one of you, like a couple of minutes, each one of you.
Yeah, look, I mean, look, the two areas of the U.S. economy we love right now are tied to consumer credit and regional community bank credit, whether that's RMBS or multifamily CMBS. We think, certain areas of workforce housing-focused multifamily CMBS have 10.5% loss-adjusted yields, 7 to 10-year average life, so that is a tremendous total return with very little risk. And then if you look at the banking system, you've benefited in terms of credit quality from not only massive executive regulatory relief, but also legislative regulatory relief, as well as tax reform. Yet despite that inducement by the Trump administration, please go out and lend, please go out and take risk, banks are still running like utilities.
Yeah.
So from a credit quality standpoint, the credit quality of the banking system is exceptional. Now, again, the downside is you're not going to make 800% like these guys think they're going to make, but I think you're going to make high single digits to low teens pretty consistently.
Thank you so much, Troy. Sam?
I see the U.S. economy growing. I see the world changing. I see it changing positively. I think the market for investors, for smaller investors, if any of you have $400 or $500 million, come and see Troy. If any of you have $200 or $300 million, come and see Deepak. If any of you have $10 or $20 million, come and see me.
Well said.
That's a good one.
And just to amplify on that, that is what I see happening. I see the money becoming a little bit more selective and beginning to flow out of the very top tier, where it's almost impossible to outperform, and is getting into these niche type of vehicles like Stan's and hybrid vehicles. That's another thing that combines the private equity model with a hedge fund model, where you can capture alpha even more effectively.
Thank you, Michael. Deepak?
So I agree with Stan. I think having managed money for a long period of time, if you can get a good manager with domain expertise that manages small money, that's the sweet spot for the investor. It's not the sweet spot for the manager, because eventually he's going to do well and he's going to grow as he should, where he makes reasonable returns and rational returns that justify the fees. But when he's small and he's good at what he does, that's the sweet spot where you can make a killing. You have to find the right manager and do your due diligence and make sure they have the domain expertise, they have the experience, they have a plan, and that's a great place to be. As you get larger, you basically have to manage risk and manage risk much better and generate returns that, like Troy said, high single digits are good returns in a market where cash is 2% going lower, right? What's wrong with that, right? And I think last year was a good year in that sense, where people got to see what happens when risk unwinds in a bad way. When equities are flying, it's the Warren Buffett line, right? When the tide goes out, you get to see what's going on, right? And so I think the perception of risk within the markets has increased, and the perception that you need to basically do something about this risk, and it's not just buying levered equity, right? Buy ETFs, pay 0 fees if you want equity returns. You don't need to go down to private managers to basically who are going to disguise their returns somehow to charge the high fees. What you need is kind of the downside protection. And that's basically a period like last year. And go back in time and see, who are the managers who play good defense and can make money when things are kind of, going up. That combination, I think the hedge fund industry is actually benefiting from. At least that's what I feel optimistic about.
Thanks a lot, Deepak. Thanks a lot, guys.